Today, we're digging into Clatch LLC. And, well, it paints a pretty interesting picture.
It does.
The facts that make you go, and understand what makes them stand out.
Right. And maybe first, for anyone listening, a quantitative investment firm, what that actually means.
Yeah.
It's not just smart folks guessing. It's about using heavy-duty math algorithms, to find investment opportunities. It takes the emotion out mostly.
It's data-driven.
Exactly. Purely data. And that approach, it can be really powerful if you get it right.
Okay, and Clatch specifically, what really jumped out at me is their focus. It's probability-based options trading.
Mm-hmm.
So it's not simply betting if a stock goes up or down, right?
Yeah.
It's more complex.
Much more. It's about calculating the odds of different option outcomes, finding these tiny mathematical advantages that, frankly, a human trader probably couldn't spot consistently or, at scale.
Okay, let's unpack this then, because here's where it gets really interesting, I think.
Yeah.
The numbers. The document says since they launched, June 2020, right?
Yep, June 20.
They've generated gross average annual returns, get this, over 24%.
Wow.
I mean, those are serious numbers, especially for just a few years.
Absolutely impressive.
So the big question is how? How are they actually doing that?
Well, what's fascinating here is the how. They talk about systematically finding mispriced derivatives. That's their term.
Mispriced derivatives.
And they use their own proprietary models to do it. Think of it like finding a tiny pricing error in a really complex contract.
An error that only exists for maybe a split second.
Exactly. Fleeting moments where something's trading slightly off its, true theoretical value. Their models are built to just grab those opportunities super fast.
Okay.
And that really is technology-enabled alpha. Alpha, that's the goal for investors, right? Beating the market consistently.
Right. The edge.
Yeah, the edge. But here, it's not about someone's gut feeling. It's an automated system designed to find that edge again and again.
So it's not just the smart models then. It's the whole engine they've built. The document mentions an advanced self-funded automation framework based in AWS.
That's right. AWS, Amazon Web Services.
And they're executing around 20,000 options contracts a year?
Yeah, roughly 20,000 annually.
That sounds huge. And self-funded too. What does that tell us? Does being that automated carry risks?
Well, using AWS is significant. It gives them, massive computing power, flexibility, the ability to scale up, process tons of data, trade instantly.
Without needing giant server rooms.
Yeah, exactly, without the old school costs and stiffness. And that 20,000 number, it's not just big, it proves the strategy works in practice. It's a real operating machine generating results. As for vulnerabilities, sure, any purely model-driven strategy has risks. Unexpected market shocks, black swan events.
Right.
But their success so far suggests they've probably built in some pretty robust risk management. And because they focus on these very specific short-term opportunities, it kind of limits their exposure to big, long market swings.
That makes sense. It's a specific niche they're exploiting.
Precisely.
So if we connect this to the bigger picture, the document also says they're looking for partnerships or institutional capital, maybe even acquisition.
Yeah, that's interesting, isn't it? It suggests they're not just thinking about trading anymore.
What do you mean?
Well, it signals they see their technology, their whole system, as potentially a scalable product itself, something valuable that others might want to partner with or even buy. It shows a certain maturity.
So they've built an asset.
Exactly, an asset with strategic value. And they're not standing still either. They mentioned next-gen system enhancements coming Q4 2025.
Right.
That really shows a commitment to reinvesting, staying ahead. They're constantly sharpening their tools to keep finding those niche opportunities.
So what does all this mean for you listening in? Clatch LLC seems to be a really strong example of a high-performance, tech-driven investment firm.
Definitely.
They've clearly found a profitable corner of the market and are using some serious tech-disciplined automation to, kind of dominate it.
It's a solid case study in how models and automation can really change the investment game.
Yeah.
And, this raises a bigger question for all of us, maybe something to chew on.
Okay.
How is this constant evolution of automated trading strategies going to keep reshaping the financial markets? And what kind of impact will these super specialized proprietary models have going forward? Finding even tinier, harder to reach opportunities.
That's a great point. Where does it go from here?
Yeah, something to think about.
Absolutely. Look, the intersection of tech and investing, it's constantly moving, it's fascinating. And Clatch is definitely a compelling piece of that puzzle. Keep that curiosity going about how technology is changing finance.
Definitely worth watching.
And today we're looking at something really fascinating. It's a very disciplined options trading strategy from Clatch LLC. They're a quantitative firm, and they've been averaging over 24% annual returns since mid-2020 by systematically spotting mispriced derivatives. And we're really zeroing in today on a specific one-year case study, May 2024 to May 2025, focused purely on McDonald's Corporation options, MCD. The strategy uses this very systematic rolling approach, adjusting option positions. And it's guided mainly by just one metric, in the money probability, or ITM probability. Okay, let's unpack this a bit.
Right, and what's really interesting here, the innovation, is how they essentially bypassed all the traditional stuff. Abstract volatility formulas, the Greeks.
Like delta and theta?
Exactly. Instead, they used ITM probability as a direct forward-looking measure. A measure of assignment risk, basically, the chance your short option gets exercised. This allowed for incredibly precise decisions, things like capital allocation, how to structure the roles. It's a really powerful shift away from methods like delta, which can be, well, a bit less direct.
That simplification sounds key.
Right.
So let's get into it. What made this MCD strategy so consistent? How did it manage such a high success rate and still generate decent revenue?
Yeah.
We need to look at the tactics, their specific risk framework, and what this means for dynamic risk management, all through this McDonald's lens. Now, you mentioned rolling. Over those 12 months, they did 392 option trades and rolls just on MCD. That sounds like a lot of activity for one stock, almost overwhelming.
It is a lot, but it was highly structured. These 392 MCD rolls, they weren't just random adjustments. They fell into three main types, each with a specific purpose. First, you had forward rolls. These were mostly used when MCD's stock price was heading down.
Okay.
The goal was to push the expiration date out further, maybe roll down to a lower strike price. This mitigated the downside risk, but crucially, they still collected premium income even as the stock fell.
Right, collecting income even when the underlying is moving against you. That makes sense. What was the second type?
Second were backward rolls, used in the opposite situation when MCD was trending up.
Oh.
Here, the aim was to lock in profits on existing short positions and then open new ones, again targeting a very specific ITM probability. So, managing risk again, but also continuing to generate income as MCD stock appreciated.
So systems for down markets, systems for up markets, we're always focused on income generation. Very adaptable. What about the third type of roll?
The third type was pretty innovative. Cross-asset rolls to SPY. Now, STY is the big S&P 500 ETF, tracks the broad market.
Right.
This was a strategic way to shift risk exposure away from McDonald's specific stock risk and onto the broader market via SPY options. Think of it like a portfolio safety valve.
Interesting. So diversifying away from single stock risk dynamically.
Exactly. It reduced that concentrated MCD risk and also generated revenue. And get this, during that same period, the fund made over 3,000 SPY option trades, and every single one expired out of the money, OTM.
Wow. 3,000 for 3,000 on SPY expiring worthless. That really speaks to the effectiveness of that broader market hedge component. Okay, so let's talk results for MCD specifically.
Yeah.
Did all this rolling activity actually, pay off in the case study?
The numbers from the MCD study, May 24 to May 25, are pretty compelling. The average revenue they generated per roll was $54.48.
Okay, $54 per roll on average.
But the really striking figure is the success rate. It came in at a staggering 99.05%.
99%. That's remarkable for options on a single stock. How are we defining success there? And what happened on that rare occasion, the less than 1%, when an option did end up in the money?
Good question. Success here means the short options expired out of the money, worthless. So out of 315 trades they tracked specifically for this metric, 312 expired OTM. That points to real risk-adjusted consistency. Now, for those 3 MCD trades that did expire ITM, they had a plan. A specific cap hedging strategy was deployed daily using reverse put spreads.
Okay, so like a pre-planned safety net.
Precisely. These are options combinations designed to limit potential losses. And the crucial part, all 3 of those ITM instances were managed and closed out profitably.
Profitably. So even the few failures, according to the main metric, were turned into wins by the hedge. That's impressive.
It is. And underpinning all of this, the strike selection, the timing, the premium targets was their proprietary time and strike weighted ITM risk model, only adjusting parameters in real time based on that core ITM probability metric.
Right. So this whole MCD deep dive really underscores the power of being systematic, of being data-driven. It shows how focusing on a direct probability measure, ITM probability, rather than just wrestling with traditional volatility metrics, can lead to a highly consistent income strategy. We saw the smart use of ITM probability, the agile deployment of those 392 forward, backward, and cross-asset rules, including those 3,000 successful SPY trades, and that really robust cap hedging for the few MCD options that did go ITM.
Absolutely. The outcome for MCD alone was $21,354.80 in revenue over the year, with that 99.05% success rate. It's just a clear demonstration of how discipline, solid mechanics, guided by a clear probabilistic metric, can really achieve exceptional consistency.
Thank you for listening to Clatch Radio.